And it's all about earnings this time. Here with our trades is Brian Vendig, president of MJP Wealth Advisors. Brian, welcome to you. And let's start with Campbell Soup. They had lower sales and profit last quarter, but the shares are up nicely today. The company said they may outpace estimates for 2024 earnings per share. What would you do with the stock?
Yeah, hi, Kelly. I think this is a stock today that's getting a little bit of a bounce because the price increases that Campbell's passed through improve profitability. But this is one I think I'm a little bit skeptical about because when we dig into the quality of earnings, we've seen that volumes were down about 5% because consumers were sensitive to price. And also the company is increasing its marketing efforts to capture share, which gives us some pause regarding the concerns about profitability moving forward and maintaining these levels. So I think there might be some better opportunities outside of Campbell Soup right now.
Well, maybe Toll Brothers shares are higher on a Q4 earnings and revenue beat. The home builder forecasts solid demand for next year. It's encouraged by lower mortgage rates. So can you buy it, or is consumer demand just too uncertain?
Yeah, John, unfortunately, I think there's still a lot of uncertainties in this space. So we're a little bearish on this one as well, at least in the short term. So when you think about the push-pull between demand and supply, we know Toll Brothers brings luxury homes to market at a pretty reasonable price point, but we know construction costs are higher, but we also know consumers' household savings have dwindled, and at the same point in time are very fickle on mortgage rates. So we know rates tick down today, which is boosting the stock and some of these expectations, but we still think there's a lot of uncertainty regarding rates next year and consumer spending. So I think there's better opportunities, John, outside of the home builder sector.
And the shares have doubled pretty much this year already. So that's an interesting one. All right, let's move along to SentinelOne then. Having, I think, its best day ever. It's soaring after its earnings topped estimates. They raised their annual revenue forecast on robust cybersecurity spending. 17% pop here for S. What would you do, Brian?
Well, this one, I am not going to be a complete Grinch for the holidays. This is actually a sector that we like in the cybersecurity space. And Sentinel has a very competitive cybersecurity product that focuses primarily on enterprises and businesses while it's still trying to increase its penetration to the consumer. And as you mentioned, the dynamics of earnings today were really encouraging. We actually saw the margins improve 8% year over year, reaching a new company record of 79%. And I think that's a favorable sign moving forward. And also, the other thing to mention, on a price to sales perspective, it trades at around 7.7 times, which is quite a discount to its rival CrowdStrike, for example, from a valuation point of view. So when you think about the headwinds, the tailwinds that are there for the space, cybersecurity, generative AI, these are products that this company is bringing to market and talking about how it's going to improve the efficiency and effectiveness in analyzing threats and improving its profitability moving forward. So for us, the cybersecurity sector is definitely an allocation that we'd consider for someone's growth portfolio.
So give us a couple of the filters that you're using to evaluate tech stocks. Beginning of the year, there were a lot of people saying, stay away from tech entirely. That was wrong. So heading into next year, how do you decide what's worth buying?
Yeah, that's a great point, John. I think you definitely have to be selective at these valuations. I think it's a combination of looking at the momentum of what's happening regarding demand for a service or a product that one of these tech companies are bringing to market. I think you do have to be cognizant of price to earnings on a forward PE perspective. And to my point, just using Sentinel as an example, a company that is narrowing its losses, you have to take a look at sometimes things from a price to sales point of view, just to make sure that you're not overpaying for growth, John.
All right. Brian Vendig, thank you.